All right. Looks like everybody is popping in here. Nice to see you guys. If y'all want to throw in the chat where you are tuning in from, it's really good to see you guys. Hi, Christina, Dennis, Gary. James, Jenny, Jennifer, Christina, Christopher, Liliana, Michael, tell us where you guys are tuning in from, and then tell us where you own a short-term rental at or where you are in your short-term rental journey. We'd love to hear, get to know you guys. We're going to be here for an hour. I tend to go over an hour. I know these guys may have other stuff they want to do tonight, but I'm really passionate about cost seg season because it saves people a lot of money. I find it to be one of the ultimate wealth creators. So I'm always happy to stay and ask questions. I like for these to be really interactive as well. So throughout everything, we're here to serve you. That is the whole reason that the three of us are here. So we want to answer all of your burning questions. This is where the rubber meets the road right now because there's not a whole lot of time left for you to get something and turn it on this year, or as Ted and Connor would say, to put it in service this year to qualify for those cost seg benefits. So we're going to talk a little bit about that. We're letting a couple other people come in here, so it's nice to see you. Ted, Trish, Susanna, Stephen, Stephanie. Okay, I'm going to try this. Shalakshmi, very nice to see you. Shyam, Shannon, Scott, Rose, Raj, good to see you guys. If you can put in the comments in the chat here where you're tuning in from, where you have a short-term rental, and where you are in your short-term rental journey. Let us know. Are you brand new? Are you buying? Do you have a ton? Are you the biggest investor in the world? Let us know. So I'll go ahead and get us kicked off here. Just to respect everybody's time. My name is Tyler Coon, and I'm the CEO and founder of Savvy STR Agents, a nationwide short-term rental real estate team that specializes, as you guessed, in selling short-term rentals to buyers and sellers just like y'all. Congratulations, Christopher, on closing at the end of October. That's amazing. Um, Ted, why don't you kick us off and tell us a little bit about yourself?
I'm Ted Lanzaro. I run Landmark CPA Group in Shelton, Connecticut. It's a national boutique tax strategy firm for real estate investors, and we deal with everybody from syndication operators to short-term rental owners, developers, contractors, everything that to do with real estate. Um, we specialize in strategic, proactive tax planning for clients. So that's like all I'm doing right now is year-end tax planning for clients.
Awesome. Connor, tell us a little bit about yourself.
Yeah, my name's Conner Iddiols. I'm with CSA Partners. We're actually based out of Linden, Utah, but have reached across the entire United States. We only focus on cost segregation. That's it. We do nothing else. We don't do R&D. Our bread and butter is cost seg, and we really have specifically the short-term rental portion down to a science. So. Um, Happy to be here, happy to talk to y'all, happy to answer any questions. Like Tyler said, it really is getting close. Now's the time, to kind of pull the trigger if you're going to pull the trigger, to get those rentals in by the end of the year.
Yeah, I see some good questions rolling in already. So if you guys have some initial questions about buying a short-term rental this year and launching it, and then being able to do a cost segregation study, anything surrounding those topics, please put them in the chat and we'll go ahead and start getting through those. We're going to let a couple people still trickle in here because I think Zoom sends an email out right at 7:30. So thank you guys for joining us so late. Um, Let's get things kicked off. The major question I think on everybody's mind is this still possible? We're at November 12th. Typically, most of my buyers are buying with a loan. They're getting lending, they're financing their short-term rentals. And so that process, at a minimum, most times takes 30 days. Right now, what I'm really stressing to people is that do not think that it's going to only take 30 days right now. You have a major holiday in the middle of this thing, Thanksgiving, that will throw some wrenches in things. Appraisers are going to be delayed, inspectors are going to be with their families. Homes are going to be full. If you're buying an active short-term rental, which is really the only thing you can buy, the homes are going to be full. They're going to be rented right now. So do not expect that you can close in 30 days right now. I'm telling people to make sure you have some buffer in there, which means we are looking at mid-December for closing right now. So the big question on everybody's mind is this possible? What do you guys think?
I mean, I think it's possible. You just have to be able to, I think the turnkey is the key, right? It's got to be turnkey. You can't, you can't, uh, you can't expect to close and then have to do some renovations and market it, whatever. I think if you can buy a turnkey property, it's definitely possible because the hard part is going to be getting the couple of rental, getting the handful of rental weeks or weekends in there so that you can establish an average.
What do you think, Connor?
No, I completely agree. I think it's going to be tough to get something staged and listed and photos. I think it has to be, it's got to be active and it's got to, realistically, you want it furnished as well. Um, that being said, there are benefits to buying furnished tax wise. So, um, especially if you can get a value for the furnishings, that's something that typically, cost segregation studies don't break out FF&E. So, um, there is a path there to actually save more if you do buy something turnkey and that is furnished. You just have to plan it right, and that's really all of this is planning.
That's amazing. Yeah. Yeah, I didn't realize that there was a benefit. Can you tell us a little bit more about what that means if you buy something furnished? What's the
Sure.
difference if you furnish it yourself?
Sure. So you get the benefit of furnishings. You get the benefit of 5 and 7 year furnishings if you purchase them and if you have receipts and if you have invoices for the furnishings to build out the short-term rental. Um, when you buy a house furnished but you don't have any value within the purchase price for the furnishings, our default is, well, you bought a house and the furnishings are there. How are we going to give a price to a 10-year-old lazy boy? I can't look at it and say, well, it's worth $600. So, um, that is something that comes up frequently is, hey, I bought it for furnished. I don't know what to ascribe to the furnishings. Um, and a lot of times I say, hey, is there any way you can ask the seller to put a fair market value or a reasonable value on it? That's a defensible value, in order to take advantage of that. And then the leftover basis from that is what gets cost segged.
Wow, that's really interesting. And so I think the easiest way because every scenario is different, every seller, every
Mhm.
buyer, every home, every cost seg study is different. So the best way to learn kind of if somebody's got a unique scenario or going through it is to get in touch with you, right? And kind of talk through it
Yeah.
individually.
Absolutely, yeah.
Cool. I'm gonna put Connor's link in the chat. So if you guys want to like inquire, ask him any questions, you can reach out to him on that link. So that'll be really helpful. So let's get to some of these questions that are already here, and then we can kind of talk through what this looks like. I know Scott at the end here, and don't worry, I'm going to go back up to the beginning of the questions, but he said, we're saying that we do not think one can get it up and running before the end of the year. So I just want to be really clear here. I think what the three of us are saying is that if you want to buy something right now, you have to buy something that's furnished that you can start renting the day after closing. That's available. There's no seller possession. There's not going to be any sort of delay in getting that thing online. You have to buy something that's going to be furnished this time of year. It's almost impossible to buy something that's not furnished and get it furnished because you have to have, and I'll let you guys speak a little bit to this, but you have to have 1 or 2 stays right before the end of the year, and those have to meet some qualifications. So let's talk a little bit about that before we answer any other questions. How long do those stays have to be? How many of them do you have to have? I've had questions like, does it have to be through Airbnb? Do we have to have receipts? How do we prove that we had those rentals? So let's go down that path.
Okay. I mean, from my standpoint, from the tax standpoint, I always like to see rental income, right? Because if you're going to put something on Schedule C, you want to have that rental income on there. You don't just want to have zero income and big huge cost segregated depreciation deduction. That's you're basically asking to get audited, right? So I like having rental income. I would say you need to run at least two two stays in there. Whether it needs to be run through Airbnb or not, I don't think it does. I mean, if you have two, because you should have little lease agreements with each of these. I know when I rent short-term rentals, I always end up with some sort of mini lease or something that comes with either through the real estate agent or through the platform, the Airbnb platform. So as long as I have those things and I can say, oh yeah, look, I had Mr. and Mrs. Smith stayed 3 days, from this date to this date, and Mr. and Mrs. Jones stayed, 2 other days or 6 days or whatever from this date to this date. I think those that kind of documentation is fine, right? And so you want to be under 7 days. And then the other thing is you've got to figure out how you're going to get the material participation classification, right? And luckily, one of I've got it actually, it's sitting on my phone in front of me because I sent it to somebody today. But one of them actually says, just do everything yourself for the STR, right? So there actually is no hours classification. It's just do everything yourself,
Yeah.
right? So, so it's possible to get your 100 hours in, right? Like if you closed at the beginning of, if you got something going and you closed by the 10th of December, is it possible to get 100 hours in? Yeah. You know, you better be creative in getting those hours in. But if you do everything yourself, that's one of the criterias. And so like I was telling somebody today, they're like, well, what do you mean? Have to do it yourself. Like, how am I gonna, how am I gonna have 2 or 3 stays? And I'm like, well, listen, uh, everybody wants to go to heaven, but nobody wants to die, right? If it was me and I was getting $100,000 tax deduction, I'd go down and clean the house between
I'm
stays,
scrubbing some
right?
toilets for 100 grand. Yeah, that's right.
Yeah, exactly, right?
Right. Yeah.
So, so
Well,
yeah, so I mean, what I do with people is we sit down and we're like, look, what is your situation? Where are you buying? We'll figure out how to get you your 100 hours, or we'll figure out how you're going to do everything yourself, right? Um, so it's everything is possible. It's just a matter of figuring out how to do it, right? It's not no, you can't do it. It's how can I do it?
Yeah.
yeah. Yeah. And to add on onto that, it's such a great benefit to be able to use the short-term rental loophole, but they don't make it so it's free. You have to put some work into it. You have to do something to get this great tax benefit. I mean, the IRS, at the end of the day, they want your money. So the government wants more of our money. So how can you protect it? You're going to have to jump through a couple hoops in order to get there. Um, so yeah, the 100 hours are tough in a short time span, but I really don't think, it's crazy to be able to get it done in a couple weeks.
Yeah, it's definitely possible. And this is our rush every year, right? Especially now with the big, beautiful
Mhm.
bill and bonus depreciation coming back to 100%. This is our rush every year. There's lots and lots and lots of people that buy by the end of the year right now. So here's what I'm saying. 35 days for lending, right? If your lender can do it in less, you have to do everything at once. When you go under contract, you have to order the appraisal, you have to order inspections, you have to do everything as fast as possible. You have to make sure that you're with a team that knows what they're doing as well. You can do the cost segregation study and all of that stuff next year. You don't have to actually do all the tax stuff this year. You got to do the buying and then all the short-term rental stuff this year. So you have to have a great agent, you have to have a great lender, you have to have a great attorney attorney or title company that's all set to make sure that closing is not going to be delayed, because that could be the difference of $100,000 or not, or more, depending on what you're buying, right? I have clients right now buying $2, $3 million properties, looking at $300,000 in tax savings. So every single one of those is incredibly important. And so you have to make sure that you're with a good team. That's something that we can help with as well, if that's something you guys are interested in. I'm going to put some links in the chat. What we've done at Savvy is we put together some turnkey listings, and so we have a whole page of them, which I think is really helpful. You guys can take a look at those, and then there's a number that you can text if you want to say, "Hey, I'm interested in this. Let's take a look at it." I think this week we've probably done 40 or 50 million dollars in real estate sales in the last 7 days, putting under contract for people. Every single one of those people is looking for the cost seg benefits by the end of the year. Now, I'll preface that with saying, like, don't buy a property just for the tax benefits. Everything else still has to make sense. And I think that the four pillars of success for short-term rentals that I always talk about are really important. And number one is not tax benefits. Number one is always cash flow, right? So for me, cash flow is king. So you have to make sure that a minimum cash on cash you're going to get somewhere between 15 and 20% minimum, right? Like that's the worst case scenario. And there's some deals on this where your cash on cash, depending on your financial and lending situation, could be 20, 30%. If you're going to go and do some value add next year, it could be in excess of that. So every deal is a little bit different, and it also depends on what you're specifically looking for. So I'll put some of that in the chat there for you guys, if that is interesting for you guys. And if not, no worries. Yes, Christopher, this is going to be recording. And no, Christina, the webinar does not count as time, right? I'll let the cost seg and the tax professional speak on that. Does anything before you buy count as your material participation?
Yeah, I usually default to no. It doesn't because you don't own a property yet. How can you be participating in an activity that doesn't exist? So, um, yeah, that's kind of my answer. The intent obviously is there to participate, but there has to be some type of limits on what we can count.
Yeah, I think the prevailing kind of information out there, I think Ted was going to say something, is no.
Yeah, no, I was gonna say I was just gonna tack on to what Connor said, which was, I typically tell people it starts the minute you go under contract, right? Because then you have
Hmm. Right.
typically have equitable title or whatever, and now you've got to start setting up inspections, you've got to go through the lending process, you've got to do this, you've got to do that. So you're accumulating time doing all of that, right? And in the meantime, there's some other things that you could be doing ordinarily. Now in this tight time frame, maybe you don't do some of that stuff, but there are some planning and photos and things like that that you could be, under ordinary circumstances, could be, putting together, starting the marketing package or whatever, with the intention of hitting the ground running when you close. That would be if you're buying in March or, April, right, as
Yeah,
opposed to November, right? But yeah, so that's, I typically say, like, put it under contract. That's when your time starts, because um, you know, people want to be like, well, I'd like to. I spent 200 hours researching. Now,
yeah,
I don't think that you can put that on your sheet, but if you ever got called into the IRS's office, I don't know if that's going to hold up.
makes sense. Christopher had a question. What are the repercussions of waiting till next year? I think the repercussions of waiting till next year is decelerated wealth, right? You're going to lose money to inflation, right? You're letting the government take a bunch of money of your money this year instead of, next year. So, I think for me, it's about a year and a half, right, of wealth acceleration. Because if you buy in January, you're not going to see that next tax bill actually get affected until next April, May, June, July, whenever you file and pay next year. Where right now you'll realize that gain in the next few months. So I think the pain is real if you don't find something this year. If you have a big tax bill, the work is worth it. Again, I want to go back to, like, it's not worth it to buy crappy property. If you like just for the tax benefits if you don't have the cash flow, the appreciation, and things like that. But yeah, I think that the hurt is really real. Joshua had a question. What are the requirements to meet cost segregation requirements by the end of the year? I think we talked about this a little bit, but let's maybe expand.
Sure. So, our understanding is 100 hours. You need to put in 100 hours, 100 active participating hours. And then you need to prove that your stays are under an average of 7 days or less. So, what does that mean? Well, if you have one stay, you can't really get an average. So you need to have two stays and show that it is under 7 days. Um, that's kind of the prevailing thought process behind it. There are technically six other ways to qualify for the short-term rental loophole. Most of them involve needing a lot more time than 100 hours. So 500 hours, you need to be involved in the activity for 10 years, completely, um, you know, completely different from the scenarios we're talking about.
Got it. Okay. Raj had a question. If a property is bought in November, December, and inheriting a long-term tenant, can they do the cost seg? I think the answer is no. They have to have the two stays under 7 days before the end of the year, right?
Correct. That's you
What
could
is his
do a
question?
cost seg, but sorry, go ahead, Ted.
So what was so what was his I'm sorry. I wanted to make sure I understood the question because I may have a slightly different answer.
Yeah, he's going to close in November, December, and he's inheriting a long-term tenant and wondering if he can still do a cost seg.
Well, doing the cost seg and being able to deduct the depreciation are two completely different things, right? So
Hmm.
so so in a scenario where you qualify as a real estate professional and you buy that exact same property and it has a long-term tenant, you're not buying a short-term rental, you're buying a long-term rental, but you can still use it to offset your income if you qualify as a real estate professional, right? Now, if you don't qualify as a real estate professional, you can still use that depreciation in two ways. You can offset net rental income from any other long-term rental property you have, or you can offset gains from the sale of other real estate that you sold, other investment real estate that you sold. So
Mhm.
so you're not stuck, but if you're inheriting a long-term tenant, you're not qualifying as a short-term rental in 2025.
Makes sense. Scott had a
Right.
question, and I see this a lot. As a husband and wife team, is the 100 hours combined?
Yeah, it's my position that you can aggregate time between two owners, right? And the other thing that comes up too that is neither here nor there as far as the answer to that question, but um, is that if I just had somebody who's they're buying a property with two other couples. Well, each couple has to have 100 hours, but the rule where it can't be more than anybody else put in does you don't have to compete with your partners. You're only competing with other outside parties. So you're competing with the
Cleaners, handymen, things like that, and property
right, yeah,
management.
right. But you don't compete with your partners. So it's not like so each couple can get can qualify with the 100 material hours and as long as they each couple files jointly they qualify separately, they don't have to compare to one another, right?
Yeah.
Which is kind of an interesting point. The other thing, and again, this is again neither here nor there, but I have to tell you that I kind of really like LLC partnerships for reporting as opposed to putting it on the face of putting it on Schedule C of your personal return. Partnership returns get audited like 1/10. Now, the audit rate for personal returns is not high at all, right? But you are like six times less likely to get audited if you use a partnership return, right? And then because the IRS doesn't audit partnership returns because there's no tax due typically on them, they're pass-through entities. So they're very lightly audited. And then when it goes to your personal return, it's one net number on your tax return versus the entire universe of income and expenses. And I think that's especially important when your income is $3,000 and your depreciation is $175,000. Right. I kind of like that. I kind of like that. I like that as an audit risk prevention strategy or an audit prevention risk strategy. I don't know which one.
Yeah, that makes sense. I think Liliana had a really good question here. It's a really common question that we get at this time of the year. If she buys a furnished property, but they want to do upgrade and redesign, which is really common right now, do they need to do the installation and renovation before the end of the year for it to be included in this cost seg study? Um, so it's interesting. Two things here. I think what I would look at, Liliana, is maybe doing two cost seg studies. And what I want to hear from Ted and Connor is what are the benefits of doing that? Because no, if you decide to do the upgrades and redesign next year, you can't take it on this year's cost seg. You would have to do two. But I think honestly that's the best way to do it anyways, because you go into renovations and redesign in mid-December, it is highly likely you're going to run into delays and not be able to launch that thing before the end of the year and then miss out on this year's cost seg and then have to do everything in next year's, which just kicks your gain down quite far down the road. What do you guys think?
Yeah, I completely agree. I love the end of the year because the way the IRS actually, and Ted can chime in on this as well, but the way the IRS views assets that you purchase that are pulled out of service before, in the same tax year when a renovation is done, um, historically the IRS has said, well, the assets you pull out of service have no value because you intended to replace them. So if you're able to buy a property, place it in service, use those assets, and then do the renovation in a separate tax year, you're able to, take advantage of what you purchased and then also look at the next year at the assets that you replace and the assets that you actually renovate the property in. Um, that's kind of our position. It gets a little bit dicey at the very end of the year, December 31st and starting construction, January 1st, but it all comes down to intent with the IRS. So, if your intention is to, buy a property and then you decide to renovate it, who are we to kind of question that?
Yeah. You think that's anything to add, Ted?
Yeah, I was just going to say in this scenario where we're trying to get something done, yeah, I would push off the renovation. I would cost seg the house. I would do what you said. I would do two studies. I would cost seg the house as is, and then when I did the renovation, I would do another. I would spend the money to do another study if the renovation was substantial. You know what I mean?
Mhm.
So if it was, if you're talking about a couple $100,000 worth of renovation, then yeah, it's going to be substantial. You're going to get nice benefit out of that, right? If you, you know, if you added a $10,000 patio, just as an example, I don't know that I would cost seg it. I would just tell my accountant, like if one of my clients came to me and said, "Yeah, you know what? I added a $10,000 patio, stone patio on the back of the house in February of the following year," I would just make it 15-year property.
Right.
I wouldn't go and say, "Connor, you need to recost seg this for me," right? Do
Makes
a
No,
sense.
report.
yeah, and our threshold realistically is upwards to six figures. I mean, if you're doing, 10 different little projects and we can just look at them and say, okay, well you renovated the two bathrooms and refloored the whole house. Well, we know the flooring's 5 year, we know the bathrooms are going to be QIP, and we kind of just pass that knowledge on to the CPA. But when it starts getting bigger, and a lot of CPAs, actually not as many as you would think. Ted's actually kind of an outlier here. He knows how to treat a lot of these assets. So, but they should be able to take single line items one by one as renovations are done if it's not a massive renovation.
Makes sense.
Yeah, but if it is a good size renovation, I like the client to go get that cost seg study so that
Yes.
so that we're not relying on Ted's judgment where we actually have a report that backs it.
Yeah, I was joking on the best insurance policy is a cost seg study because if anything happens, the IRS comes knocking. At least you have something to fall back on. You have someone to fall back on to answer their questions. So.
Well, and I'll tell you guys, my best return on investment in the past 14 months has been my insurance policy. Uh, After this car wreck, totaled car, I had a car stolen during the hurricane, and then we flooded our entire house 2 weeks after the hurricane. I just have to say a big thank you to Allstate, who has been continuously nice about writing me checks for the last 14 months, and I will never complain about insurance cost ever again. Joshua has a good question here. And I think that this is something everybody really should pay attention to because he mentions at the end of his question that he's got a non-working spouse. So Joshua said weekly lease agreement counts as short-term stay. How do we document 100 hours? And weekly lease agreement, I would just make sure that that's under 7 days, right? Like don't do a bunch of 7 day stays. And I'll let Ted and Connor talk about that a little bit more. But how do we document 100 hours participation via non-working spouse? I'll let Ted and Connor talk about that more, but what I zoned in on or what I zeroed in on there was that you said you have a non-working spouse. You need to go online and you need to look up real estate professional status. You need to get your non-working spouse the qualifications for real estate professional status because that's going to save you lots of time and money, not even having to think about material participation ever again. Because once one of you has real estate professional status, you don't have to materially participate in the property. You can hire a property manager day one. You don't have to ever set foot at the property and still do a cost seg and claim the bonus depreciation on that. So as a real estate agent, I don't have to materially participate. I can hire a property manager on day one, never worry about it, still claim the bonus depreciation. And you can too. It is not that difficult as long as you have a non-working spouse to get real estate professional status. And I'm interested to hear your guys' opinions on that too, if you think that that's probably the most important thing that Joshua could do.
Yeah, I mean, if if you've got a non-working spouse who has an interest in real estate, then that works, right? And we like I do a lot of that kind of consulting where, we'll actually talk to a couple, I'll shoot them off ideas on what kind of business, what kind of real estate business to start, or we take the spouse and we put them in charge of the entire portfolio, and then we start documenting hours. We have track, we teach them how to track and how to document and all of that. So that I think is a really good strategy if the non-working spouse is interested in real estate. If it's not, it's also a good strategy for divorce. So that's a really bad strategy. That's a bad financial strategy. Um, as far as the week to week thing goes, um, you the IRS says that if you have a week to week agreement where the tenant comes in at 3 in the afternoon on one Saturday and leaves at 10 in the morning the following Saturday, that's considered a 6.5 day week. So you're under 7 days
Got it.
because you've got that whatever 6 7 hour spread between when people leave and when people can come back in, right? And so people that do week to week, and I know a lot of like here where I live in Connecticut, a lot of the short-term rentals, especially the ones that because people only rent here over the summer, when it's warm, we there's a lot of that week to week stuff, week to week beach houses, basically.
Makes sense. Okay, cool. Let's see. What is the next question here? Okay, we already answered that. What's the back of the napkin rule for deciding if a cost seg makes sense? I really like this question.
I typically say it depends on everyone's tax situation. Somebody might need 30, $40,000 in deductions, and that's 10K, 15K in tax savings. That might be, something they need, or they want to pursue. But realistically, 250, 300K range is when the numbers start to make sense more of the time. Um, 250 to 300K basis range, not necessarily acquisition range. The acquisition less land being the basis. So depreciable basis range of 250 plus, the numbers start to make a little bit more sense. Especially with 100% bonus. 40% bonus, numbers probably won't even make sense there. So, realistically, that's where you're at is in 2025, 26, 27, baseline, you probably want to look at 300, 350, $400,000 properties minimum to try and get to a 250, $300,000 basis to depreciate.
Yeah. I'm gonna add something to that. And I think that's a really good point, is that there has to be some minimum value, otherwise you're not getting enough bang for your buck, right? But I would also tell you, for my clients, I say to them, listen, if if you make six or $700,000 a year, and you're using the cost segregation study to cut out the income at the top, at the highest bracket, you're taking income down from 700 down to 500 or something like that. Cost segregation studies make so much sense. And the reason is every dollar of bonus depreciation you get is worth 30 plus cents to you into actual tax savings. Now, if if I made if I make $100,000 a year and I'm doing $100,000 cost seg study, I'm taking my income from 100 to zero. It's not nothing. I'm probably saving $10,000, right? But I might be spending, Connor, what does a cost segregation study cost?
Yeah, probably around 3,500. Yeah.
Okay, so I'm getting a 3x kind of return on my investment. It's not nothing, right? It's still good. But if I could spend the same $3,000 to get a cost segregation study that brings my income from 7 down to 5, and I'm getting 30 something cents on the dollar, that's $100,000 tax savings, right? So now I'm got 30x. So I like that. I like getting a lot of bang for my buck, with the cost seg. The other thing I would tell you is you this is not a short-term game. Like, I had somebody say to me, well, can I do a cost seg study this year and then I'll sell the property next year? Well, no. Well, I mean, you could do that, but you're going to recapture all of that depreciation the following year unless you do like a 1031 exchange or something. So it's not. So typically, I like a hold period, and a lot of people say 5 years. I would go down to 3 in certain circumstances. Again, it's all kind of, when I look at it, I'm looking at a client situation over a period of years, right? And telling them whether it makes sense or not, right? Because the thing you don't want to do is you don't want to use bonus depreciation to offset low income if you're going to have really high income for the next 5 years. Because then when you go to recapture, you're going to be saving at 10% and recapturing at 25%. It doesn't make any sense.
Makes sense. Scott had a good question here. He asked thoughts on a conventional second home loan and then put that in a holding company, eventually an LLC and a land trust. I can explain this really quickly. Most of my clients these days are still using a conventional second home loan, 10% down. I even have lenders that can do 10% down up to 2 or even 3 million bucks. That's what I utilize myself if I possibly can. It raises your cash on cash return, conserves my cash for me to put into the property, which then I can raise that cash flow even more, better than just paying off a little bit more debt, or actually mostly yeah, paying off a little bit more of the debt. And what all lenders tell me is that they've never had a lender come after you for moving it to an LLC that you are the sole owner of after closing. If that did happen to you, you'd probably be the first person that ever happened to. So that is kind of the prevailing wisdom there. So yeah, definitely possible. You can put it in an LLC. You can do a land trust, things like that. Kate is saying to confirm, if I buy a short-term rental with a partner and we both have 100 hours individually, that still works for the STR loophole. Is that right?
Yeah, assuming you're under 7 days also, yes.
Okay. Mohit asked if we buy a property and finish renovations next year, can we just do one cost seg study next year? So just one study? Yeah, your tax benefits are just going to come in 2027, right?
Right. Yeah.
Yeah, correct. Unless they're actively renting now and then doing a renovation at the same time, um, they technically could have a look back study and a improvement study. But if you buy a property, don't place it in service and do a renovation, then yes, it would be in 26. You'd get the benefit in 27.
Interesting. Okay. I'm sure that there's a whole rabbit hole that you can go down there on very specific individual
Yeah.
needs. So I'm just going to point
Yeah.
everybody to that link that we put in the chat again, that if you do have a very specific situation, we want to be really respectful of everybody's time here in the group. And I just want to thank everybody. This has been a really sticky webinar so far. Almost everybody that was on in the beginning is still here. So I just want to thank you guys for spending your time with us this evening, and we hope that this helps. So Christopher is saying if we repaint, wallpaper, installed patio, hot tub, sport court, converted the garage, do two separate studies. Christopher, that's all about timing. If you can get all of that done this year, that probably would be best. That way you're capturing everything all at once. I'm not a CPA, so I'll let Ted speak to this, but I imagine one study is better than two in terms of audit risk, right? It's just less eyeballs, less times that they have to look at things. I may be wrong there, and I'm excited to hear Ted speak about that. But you get your benefits a lot faster. You get them on your 2026 tax instead of 2027. But if what you're saying, Christopher, is that you paint, wallpaper, patio, hot tub, sport court, converted the garage next year, then yes, you would do two separate studies, unless you want to do your one study next year and then just take the benefits in 2027. So it's all about timing, I think, here. Do you get everything complete before the new year or not? And then the second question is, do you want to take the tax benefits this year or not?
Yeah, no, and I would agree with that. And I think it's really specific to a person's situation and the timing of where you are in a given year, right? Because I can make an argument either way, depending on if you told me what your income was for each of those years, I could tell you I could make an argument to go either way. But if I can get if I can buy the property, do the renovations and get the property up and running, get my hours in, and blah blah blah. And I'll do that all in the same year, like because I started in January or February. Then I think it's advantageous. I think it's advantageous to just whack it all out, right? Why pay for two studies if you can do it with one? With that in mind, if you're really doing a major renovation, you might want to have a talk with Conner about the fact that, hey, I'm doing a major renovation. What steps do I need to maybe take advantage of the abandonment piece of that study, right? Because I'm going to be throwing things out, right? And there's some tax advantage
Yeah.
to that.
Connor,
Yeah.
anything to
No,
add?
100%. Yeah, yeah, you do get tax savings. You can double, triple dip if timing is right, and that's kind of everything with cost seg. So, say you do a cost seg in 25, you do a significant renovation in the middle of 26, you can remove all of those assets from your books that we capitalized in 25, recapitalize the new ones, and then you're able to take partial asset dispositions on the portion that you threw out. So you do get multiple types of benefit. You get the depreciation, and then you also get the secondary depreciation with the renovation and partial asset dispositions, which is a whole other rabbit hole.
Yeah.
Okay. And we are getting down to the last like 15 minutes here, and we still have a ton of questions. So I kind of want to be able to hit the meat and potatoes of these things and go quick through them, just so that everybody feels like they really got good value. Rini says if they close, I'm not sure he or she, on a brand new short-term rental in December, their biggest expenses are furnishing the house. Can you use furnishing expenses for cost seg? Hell yeah! Make sure you get it all done this year. Okay, Hamonk says, oh, this is really technical, so I don't even know what this means. How does the accelerated cost seg depreciation impact taxes for folks dealing with AMT? In our case, AMT is greater than regular tax, and I'm not fully sure how beneficial accelerated depreciation is going to be for us.
I would have your CPA run a tax projection, get the benefit analysis from Connor, right? And then run the anticipated benefit through your return as a projection to see whether or not it's going to reduce your taxes. Once you get into that, and again, this is a rabbit hole so deep you don't even ever want to get into it. But once you get into the AMT, alternative minimum tax, you're probably not getting a lot of benefit, but I think it's so specific to each individual situation that I would have a CPA put all your information like a projection into the return, and then put that cost seg in there and see what it looks like, right?
Yeah.
Before I made the go decision.
Makes sense. Asmina had a decent question here. Ted, this is probably for you. If I buy property under my name and then quit claim it in January to my LLC, will I use my LLC name in the 2025 tax return?
Interesting. I mean, look, if it's a
Probably not.
single,
If the income didn't go there, probably not, right?
no, I mean, I don't think there's any benefit to that. I don't know why you would do that. In other words, if it's a single member LLC, it's going on your personal return anyway,
The
right?
past.
So there's no real reason to disclose, oh, I have an LLC. There's no tax advantage to it, right? Um, but if it was a multi-member, if it was a multi-member, I'd probably try to get it into the LLC before the end of the year so that I could report it on a partnership return instead of on my personal. But yeah, no, if you're not going to set, and again, you got to be careful with all of this because you got a lender who, probably doesn't love this idea, right? Um, and your insurance company might not love it either, by the way. So yeah, just be careful with the LLCs. But um, I tell people, listen, I would wait a little bit. So I think that's about right. If you buy in late 2025, don't even worry about the LLC. Put it into Set it up in 2026, and you know and look, I mean, there are caveats to that. If I'm a really high net worth person with a lot of other assets, maybe I'm buying in the LLC to start with because I can do that because I have the capability of doing that, right? Because I want the asset protection because you know, it's not like short-term rentals have zero, risk, of, liability risk, right? You get good insurance and you manage the property, right? And you try to minimize that, but it's not
Yeah.
risk.
Leah, who is our amazing savvy agent in the 30A area in Florida, asks if buying a property this year and doing a cost segregation study, but the house needs a pool and about $100,000 of renovations that'll be started next year, what's the best way to write that off next year since land improvements would typically be considered? So could that be reviewed for an additional study the following year?
Yeah, that's what I would say to do. As long as it's in service in 25 and you get the qualifications met, I would look at the improvements and I would look at the land improvements, obviously specifically the pool. If there's any interior improvements, make sure to outline that they're interior. That's very important. But make sure you can differentiate between interior and exterior. It'll help you out tax wise.
Okay. Havziba asks, can cost segregation be done for the principal home where we don't live, which is rented to our business?
How many years in prison do you want to
Uh, yeah, I was gonna say I don't think so. Um,
No prison.
no.
Okay. Michael asked, what are those bonuses Connor mentioned? 40% versus 100%. So likely, Connor, you're talking about the big change this year and why there's such a big rush for cost seg season again this year, like there has been in years past, which is that the bonus depreciation was waterfalling down. It was had tranches every year. This year was 40%, next year is 20%, and then after that it was gone. So let's say at 100%, you were going to save $100,000. This year, without the big, beautiful bill, all politics aside, we're talking about this one piece, you would have instead only saved $40,000 instead of the 100. Next year, that would have been 20. And in 2028, right, 2027, that would have been nothing. And there would have been no more bonus depreciation on these. And so the big beautiful bill has brought that bonus back to 100%. There's not an expiration date on that. Is there, Connor, or is there?
2029, technically, there is no expiration date, but they're gonna have to refund the tax law come 2029. So technically 2029, but there was no actual legislation saying that it would expire. It is indefinite per Congress.
Okay. Hamank has a good question about real estate professional status, which I don't think is talked about enough, because really to qualify for that, you need 750 hours, which comes down to about 15 hours a week, which I think a lot of, if you're a couple, there's a stay-at-home spouse. This isn't that difficult to qualify for, especially when you're running something like a short-term rental. If you have two or three, your guest messaging is probably a couple hours a week, pricing the properties a couple hours a week, communicating with cleaners and handymen is probably a couple hours a week. Those things add up really, really quickly. And I'm interested if Ted or Connor has any kind of opposing views there. But Hamank's question is if a non-working spouse qualifies as a real estate professional in 2025, will they lose any depreciation benefits by delaying the cost segregation study to 2026 instead of doing it in 2025?
You don't lose anything. What happens is you would have to file a Form 3115, catch up that depreciation, and then what you get is the catch up less what you took in straight line in 2025. So you don't lose anything. You're technically getting all of it in 2026, but you have to file an extra tax form. And it's sometimes not the easiest tax form to file. So
Okay.
Yeah, and you're delaying the refund. That's all.
Yeah. Not accelerating your wealth building, which none of us are a fan of. Jenny asks, can I buy the property this year and do the cost seg study next year and apply to my 2025 taxes? Yes, you do not have to do the cost segregation study in 2025. Otherwise, Connor wouldn't get a Christmas or New Year's. So you are more than welcome to do your cost segregation study next year. I'm sure, in fact, that Connor and his company would probably appreciate that. And you can do that anytime as long as it's before you file taxes. You would submit the cost segregation study to your CPA sometime before you file taxes. They add it on there and then you pay your bill. Is that right?
Correct.
absolutely, yeah.
I'm like a tax professional. Um, I'm not licensed. Don't take any of my advice. You got to listen to these guys. Steve Jones. Yeah, Steve, you have a lot of questions about different partnerships and cost segs, 1031ing out of it, how many people can take the benefit. I would highly recommend you to click on that link and just talk to Connor because I've got 10 or 12 questions from you here that are really in depth to your situation. And it would probably take an hour for us to go over all of that too. So while I want to get to all your questions, I realize you have a lot and they all matter as well. So I really want you to get the time that you need on that. I don't want to rush through it. Um, Kate asks if she buys a 400, we got the same question last week. If she buys a $400,000 on lease land, does it make sense to cost seg it? The land has no value.
I mean,
What is
yeah,
on the line?
a house.
Oh, okay. I'm sorry. Go ahead.
Maybe a condo, a house,
I
I'm not sure. Last time
condo
we talked
house.
about the condo, so.
I actually just had a conversation about this with manufactured homes on leased land yesterday, and yeah, I mean, you'd actually get better benefit than if you bought a property that you own the land on because you don't have to pull out land. So yes, you can do a cost seg. Um, you'll get more benefit than you theoretically would with land included, and you can deduct I believe you can deduct the lease that you pay for the land.
Yeah.
Very interesting.
Yeah.
Okay, Steve did have a good question here that kind of pertains to everyone, I think, and something I'm interested in hearing as well. There appears to be a lot of cost seg service options, from a cost-effective do-it-yourself option to an expensive full-service solution. What's the difference?
So on our end, we only focus on engineering-based studies. So the IRS does allow 6 different types of cost seg studies. The two that they prefer are engineering-based cost approach and engineering-based residual estimate approach, essentially estimating out the price of assets. We focus specifically on those, and that's what we call an engineering based study. A lot of sampling studies or a lot of these DIY studies are essentially shooting out a number, which I'm not saying it's a too aggressive of a number or an indefensible number, but it's a number based on a number of properties that they probably have done over a 10-year period. Um, in order to shoot that number out, they have to be more conservative because they're not seeing what's actually there. And when they do that, that's leaving money on the table. So our position is, do what's best for you financially, but most of the time we come in higher than those companies, and we come in higher than um, a lot of other engineering-based companies as well, specifically, and that offsets kind of the price difference in those different types of reports.
Cool. And I just want to point out again, real quick, if you want to talk to Connor, and you guys do like free consultation, like this link that we're putting out there, you type your info in, you get a consultation, you speak with Connor or someone on his team, and you get all these questions answered, and then decide like if you want to do a cost seg study, if you're, what that all looks like. So, yeah, I'm sure he's happy to get on a call with you. And Connor's been such a blessing for our team. He's our direct contact at CSA, and he works directly with all of our clients. So I just want to say thank you, Connor, because you're always willing to. I mean, it's 8:30 at night, and you're here answering these questions. Like, sure that you don't own the massive company that is Cost Seg Authority. So I just want to thank you for putting in your time and effort on behalf of all of us.
Of course, I appreciate that.
And Ted, as well, we're nearing the end here. We will get to all of your questions, but I just want to thank you too, because, you're constantly available for people. And that's really, most of the time, I can't get my CPA on the phone and I can get you on the phone. So I just want to thank you for always being available for all of our clients and our savvy family, our agents, whenever we have questions. What's the best way to work with you? What is your ideal type of client? Who are you looking for, and who can benefit most from working with you?
I mean, look, I want to help real estate investors. That's what I do for a living, right? So um, if you're buying short-term rentals and I think you do need help with the reporting and with the strategic part of it, with the documentation of your hours and things like that. And that's what we're providing all of those resources. So, I don't really, you know, if I can help somebody, I take them as a client. I want to take clients that when I'm done with them, they go, wow, that's awesome. Right. And if I can't help them that much, then I tell them, you don't need me right now, you know but you may in the future. Here's my number, call me back when you've got something a little bigger going on, and then we can talk about it. But yeah, like, and so I'm really easy to work with. You email me and I send you a link to my calendar, essentially, right? And then then we have a conversation. And I want to just take 1 second just to go back to what Conor was just talking about. And that question about the DIY studies, if I got called into the IRS's office, I would want an engineering-based study in my hand.
Mhm. Yeah.
It's- yeah, I agree. And I use CSA for all my cost segs. So there's nobody on this call that I wouldn't use myself. We are on the phone with Ted multiple times a week with questions and different things. And I saw Christopher posted something. Maybe they've gotten different information from someone else. There is a lot about all of this that is up for interpretation. There is not, everything is not very well defined by the IRS, by the government, by the law. There are different opinions out there. And so I think all of our advice would be seek all opinions and then make your own decision, right? Ultimately, your own tax situation is up to you. You go to professionals for advice and then you make the decision. So do more research, figure out where the most common themes are, what the best prevailing advice is out there. And that's the best you can do, right? So I think that would be all of our advice for the most part is go get as much advice as you can, see where it all lines up, and then do what's best for you at the end of the day. So we put Connor's link. I put Ted's email. I put Ted's link there. Yes, to everyone that asked, this has been recorded and this will go out to you. I think that's it for all the questions. Brandon Thompson's asking me to find him a killer property this week. I've got like five. I think I already sent them all to you. So yeah, definitely we can do that. Thank you guys for coming and attending. And I'm glad that, yeah, we got this done on time and got everybody's questions done. Ted, Connor, you have anything to add?
Just thank you. I'm glad you invited me on, and it was a pleasure to just hang out and talk real estate. It's always fun.
Cool.
Yeah, I was gonna say the same. Thanks for having me on. Thanks for letting me talk, and I appreciate everything you're doing in the short-term rental space.
Yeah, there's prettier faces that y'all could have been watching for the last hour, so we appreciate you coming and looking at ours. All right, y'all. Well, with that, I'll end it. I'm gonna go have dinner, and I hope you guys all have a great evening. Spend some time with your family and your loved ones, and we'll see you soon.